You know what? I think we've passed the threshold of what's reasonable, Steve. So it's time to get started. And again, thank you everyone for joining this Placer AI webinar. Big questions facing retail. I am thrilled to be joined today by now like a multi-time guest. I mean, this is like the Five Timers Club for SNL. Steve Dennis, the president of Sageberry Consulting, the best-selling author of Remarkable Retail, and many, I mean, like literally too many other to list here, projects. Steve, thank you so much for being here.
Well, thanks for inviting me. It's great to be back on with you.
Always a joy. So quite a quick look at what we're going to be looking at from an agenda perspective. We're going to start off with a very brief introduction to Placer for those of you who are new, just so you have a sense of the data you're going to be seeing in the background and what informs at least my opinion. We're going to look at retailers and segments, and then we're going to look at the big trends, and then finally we are going to end with Q&A. But even better, if you have a question at any point throughout the conversation, please plug it into the Q&A button situated at the top or bottom of your screen, depending on how you have Zoom configured, and we will try to get to those questions within the course of the conversation. Introduction. So what is Placer? What is the data that you're going to hear at least me talking about? Placer is a location data company. What that means in the simplest form is people vote with their feet, and we're showing you how they vote across the United States every single day. How do we do that? We view a panel of over 30 million devices throughout the United States. Very critically, this is all anonymized aggregate data. So we are GDPR and CCPA compliant. We then analyze that data with machine learning and AI algorithms to make estimations on visits to retail locations across the country. And we then present that data in a wealth of different reports on our platform on everything from visit counts, true trade areas, the customer journey, cross-shopping, and a whole lot more. If anyone is interested, we have a free version of our premium product available at placer.ai. We also have free tools available in a section on our website called The Square, placer.ai-square. And with that, it's time to dive in, Steve. So I think, like, as opposed to many where we kind of start off with a negative, I think today, you know, because it's us and we're so optimistic, I think it's time to start with the positive.
That's totally on brand for me.
I'm pushing you out of your comfort zone. So I want to start with asking, so two questions, but start with this. Which retailers have impressed you most and why? And I want to add the context of what we're seeing, economic headwinds, still this post-COVID recovery, a lot of the challenges of too much inventory after having no inventory. Who has impressed you and why?
Well, you know, strategically, I think over the long term, you see this phenomenon of bifurcation where there's a lot of strength on the high end. So you've got retailers like RH that have done incredibly well, but a lot of the action over the last couple of years in particular, and I think you see from this data here, has been more on the value side of the equation. So that's everything from some of the off-price retailers, the hard discounters. We've got all the data here, and then some of the discount mass merchants like Target. So I think, you know, a lot of that has to do with strategically how these brands are positioned and being truly remarkable, as I like to say. It has to do with how well they're executing. But of course, we're also seeing a lot of things that are really kind of the moment, you know, the COVID effects, kind of rebalancing that's going on, as well as what's going on with some of the shorter term factors, like you mentioned, the inventory situation, as well as kind of the macroeconomic headwinds we're starting to see.
And for when you look at brands that are doing well, even within that lens of the bifurcation of retail, what are the wider lessons that you kind of take for retail, for the retailers overall or the sector overall, when you say, hey, this bifurcation is happening, these are brands that are really getting it right? What are kind of those key lessons to take away?
Well, some of it are maybe sounds a little bit trite, but I think it's, you know, an intense sense of who the customer is and being hyper focused on that, not trying to be a little bit of everything. You know, to sort of talk about it in the negative, we've seen for years really now this kind of collapse in the middle, where you have retailers and the department stores, which I think we'll talk about in a little bit, are kind of the poster child for this, where they're neither fish nor fowl. They don't offer the greatest convenience and value pricing and assortments that are relevant, but at the same time, they don't really offer a particularly unique product or a unique experience, or they're not in the right kind of location that customers favor. So some of that is just really having a business model that's architected to a particular set of customers and meeting those needs in a really intense way. think the other thing which is characteristic of lots of retailers, and I would point to Target in particular, is really leaning heavily into kind of this hybrid world that we've been experiencing for years now, this blend between digital and physical, and really trying to harmonize that experience. So Target in particular, I think, has been impressive, not only because of some of the things that we look to them for, convenience and great private brands and great mix of product, but they've really figured out how to blend digital and physical in an interesting way. So they've got about 20% of their total product, which is ordered online, but about 95% is fulfilled from store, whether that's the customer going to get it, like curbside pickup or buy online pickup in store, or it's shipped from store. And it's that blend and making it really easy and seamless, which I think is characteristic of many, not all retailers. I mean, there's certainly some retailers that do well that have not needed to go that far.
You make such an interesting point. I think I credit you, and I think rightly, with kind of the harmonized retail terminology as opposed to the omni terminology, which basically just says it's not multi-channel, it's one overarching channel, but it is different channels. It's just asking this question. And I think this is why you see such vast differences across segments and retailers of what their omni approach looks like. It's because you're trying to find this, how do I find the ideal balance for my customer? But it comes back to what you said before of, if you're one size fits all, you don't know who your customer is because you're trying to make everybody your customer, and therefore you're almost losing everyone.
Yeah, I think we're in an era that certainly has evolved over probably 2 decades, really, in terms of some of the things that I've seen, but it's been really brought to the forefront during the COVID time of one size fits all is kind of one size disappoints many. Like, it's very hard to really be a little bit of everything to everybody anymore. But I think if you understand the various customer journeys, which can vary by type of customer, it can vary by the purchase occasion, and you're looking to both reduce that friction as well as hopefully kind of amplify the wow, then that's a good place to be. But it will be very different from retailer to retailer.
That's a very important point. And now we get to go into the slightly more ominous tone. The music playing in the background. Yeah, exactly. So same question, but the reverse now. Which retailer or retail segment has the most cause for concern, and why?
Well, I don't know if Bed Bath & Beyond is a segment unto itself, but that's probably an obvious point to make. I mean, generally speaking, so kind of stepping back, and I know I'm being a bit repetitive here. When I look at retailer performance, I tend to look at strategically, do they have a remarkable business design? Secondly, are they executing well? And thirdly, what are some of just kind of the overall macroeconomic or particular factors? Department stores, even though they've had a bit of a dead cat bounce, I guess you could say, people familiar with that term, a little bit violent, I'm sorry. But department stores have been losing market share really for 25 years. And their overall market share is about a third of what it was, I think, going back to around the year 2000. So department store issues are not new. And I don't think fundamentally anything is happening to change that. I would say in some cases that's true of many category killers that sell commoditized products. So Bed Bath & Beyond being kind of the poster child for that right now. Toys R Us faced similar kinds of issues going back 3 or 4 years ago. So again, it's just very hard to be in this middle place. And then if you happen to have disadvantageous real estate, which is generally characteristic of most department stores, and you've got sort of a mix of executional factors. I think Macy's not executing particularly well, Kohl's not executing particularly well, Dillard's a bit better. You see somewhat different outcomes, but the cause for concern are really long-term issues, not helped by some of the macroeconomic factors at the moment.
So considering that kind of execution issues, the macroeconomic factors, and kind of this wider challenge that the department store space in particular has seen, you are now given the keys to any department store that you like, and you have to kind of turn it around. What would you do? What's the strategic approach?
Well, I'm not going to give you a very compelling answer because, I had an opportunity to do this at a department store about 20 years ago, and I ended up deciding it couldn't be done and left. And I'm not trying to be too facetious about that, but until Elon Musk invents a time machine, a lot of the issues of these department stores are not easily fixable. And that's because their target consumer and their go-to-market strategy, it's just hard to see how to make it relevant. You know, this idea that you're going to have, I mean, if you think about it, I don't know, my own experience is that as I walk into a Macy's or a J.C. Penney, you know, nobody would create that business model today. It is just not a business model built for these times. The stores are too big, the target customer is too broad. You know, when consumers can get just about anything they want from anywhere in the world, you know, often at a lower price, often in a more convenient location, whether that's e-commerce or, you know, you think about off-price retails, there's 5,000 locations of off-price retail relative to department stores. So there's almost always a more convenient choice, whether that's physical or the internet. And there's almost always many retailers that have a much more targeted, personalized kind of product offering. So these are fundamentally structural issues. So it's hard to work out how you fix these problems without fixing the real estate. And that is something that can't be financed and can't be executed. But in the meantime, you know, you can certainly continue to do what some of them are doing, which is try to offer more differentiated product. You know, in some cases, that's partnering with some of these digitally native brands or strengthening their private brands. It's about enhancing their environment. But, you know, ultimately, I think it's a bit more of a real estate issue than it is an executional issue. So I don't know. Honestly, you know, as I say in my book, here, I got to do my little, you know, my publisher yells at me if I don't do the promotional link. But as I say in my book, you know, there's a big problem to watch the last 20 years happen to you. And most of the retailers that are in trouble, their issues started to unfold 15 to 20 years ago, and they mostly watched and didn't act as radically as they needed to. So, you know, it's hard to close that gap. Maybe impossible.
I mean, I saw you post on this, and I know a mutual friend of ours Simeon Siegel has talked about this a lot, of like how many of these direct to consumer brands are going to actually start looking towards wholesale and kind of dropping the D, so to speak. Do you think that offers a potential boost, as like kind of these cooler, younger, it's not just so much the experiences, is the experience so exciting in these department stores? Is there this potential like neighborhood goods-esque way to make it fresher and more exciting?
Sure. I mean, I think the challenge is many of those things, you know, just sort of make you a slightly better version of mediocre. I mean, it's well worth doing, you know, finding those products that give the customer a unique reason, or, you know, somewhat unique reason to choose you over the competition. And by the way, aren't so easily price shopped on Amazon and other places. You know, that's a good thing to do. Whether that's enough to really move the dial in a significant way, I'm skeptical of it, but I think those are worthwhile strategies. The other thing, when you're a Macy's or you're a Kohl's, you know, let's say you have 5 or 6, 10 interesting brands. I mean, they're very unlikely to affect more than, say, 4 or 5% of your volume if you just do the math. So again, they can be great incremental opportunities, well worth doing. It's just a question of whether or not that will, you know, fundamentally change your competitiveness when you've got a box, you know, in a real estate position, which is disadvantaged to the best competition in most of for most of the customers in most of the categories in which you compete. I mean, that's the strategy issue. It's not like those aren't good ideas, sort of on a case by case basis.
That's interesting. Now, looking kind of specifically at the environment we've been in, and I think, you know, 2022 is almost going to be defined by how volatile it was, and kind of it feels like every other month it's something new that you're being asked to cope with. Which retailer do you think has gained the most? And you kind of alluded to this at the top a little bit with your kind of those value oriented. But if you're looking at retailers, I mean, for me, it's Dollar General. You know, that dollar lane kind of has the biggest potential. Who do you think gained the most from this volatile situation in 22?
Well, I think that, you know, in general, the trading down kind of phenomenon, the value orientation, I mean, it's hard not to find a retailer that's operated reasonably well that hasn't benefited. So, you know, off price, Sam's Club, Walmart, Target, you know, have, and, you know, generally all done pretty well. You're seeing a little bit of a kind of rebalancing that's going on, which largely has to do with some of the COVID effects. Home Depot, Lowe's, a bunch of home retailers did really well. Now they're not doing so well. But I would say generally the value lane has been the place that's been pretty interesting. Retailers like Five Below or Tractor Supply is a little bit different, that have I think, really clearly differentiated position and aren't as national yet.
Yeah.
As the thing with the dollar stores and the thing with off-price retail is, and I don't know how high is up there, but I'm still kind of amazed by how many locations have been opened over the past decade, which still seem to be gaining traction. Whereas with retailers like Five Below or Ollie's, they're not everywhere yet, and they're getting a lot more growth out of just being new to different trade areas and customers learning about them. So you see a little bit of difference there.
Yeah, it's also that just how disciplined these expansions are. Like they know what they're doing, and they're doing it in these new places. But you are seeing kind of that next level with Five Below offering this kind of $10 options, and Top Shelf for Dollar General. There is this kind of interesting up market push from some of these lanes that I think is really interesting. But I was wondering on kind of this same kind of unrest, kind of questioning, when you think of how crazy the environment has been, how do you kind of judge retailers over the last year? How much of do you grade them on a curve? Do you give a pass to certain segments or retailers?
Yeah, I think it's I feel like we're in this over time, I think the pace of change has accelerated. Things are inherently more volatile, but I don't know that I've been at this for 40 years. I don't know that we've ever seen as volatile a time, whether we're talking about, the war in Ukraine, the degree of inflation, which is obviously related to that, this kind of shifting customer dynamic, which we see very clearly in your data about customers, returning to physical stores. Some of that I think is very much a kind of largely post-COVID effect. Some of that, as I was alluding to earlier, is this kind of mix of products that are being bought. We've got this situation where a lot of retailers are vastly over inventoried and are promoting at a level that, we've been saying for years that this promotional intensity can't get any higher, but now it is. I think it's just a really, really unusual time. And so I don't, not that I feel like I have the gift of prophecy in general, but I think to the extent that I've got any intuition about how things are going to play out, it's just a little bit harder to rely on that, because even if you've been doing this for a long time, we haven't seen really this kind of mix of macroeconomic factors and the impact of something like a pandemic driving a lot of what consumers are doing.
Yeah, I think there's gonna be a lot of Monday morning quarterbacking in about 2 years from now. And you're gonna look back at the same people who are criticizing certain decisions now, being like, obviously, how did nobody else make that decision? But it's it's just a crazy environment.
Well, to me, there's a couple things that are implied by this. One is, I think not that this isn't a good idea in general, but I think a fair amount of humility is called for, because many of us have been pretty wrong about stuff, and some of that is we play into the certain kind of narratives like physical retail is going away, retail apocalypse, or e-commerce has been accelerated by 10 years, when it's actually more like a year. There's just some stuff that I think the level of discernment probably was clear wasn't going to happen. There are also plenty of things I think that could not be anticipated because of we just haven't seen it before. So I think being humble about that and being curious about what to do with it, and then just building more agility into your business model, because I don't think volatility, I'd like to think, is going to be a little bit less going forward, and inflation will come down at some point, and we'll get back to maybe more familiar patterns. But I think we're just in a fundamentally more uncertain, volatile world, than we've ever been, and I doubt that's going to change.
I mean, apropos what you just said, like the concept of agility is maybe more important than ever, and we hear it when we talk to customers, whether it's retailers, whether it's kind of the real estate professionals, how important flexibility is, how the growing level of comfort with kind of risk and not knowing, and leaving some stuff up to chance, because the optionality is a value, the ability to move faster is
100%, yeah.
important.
Yeah, I think that's a tough, I got asked this question the other day. I was doing a speaking gig down in New Zealand of all places. And I got asked a question about agility. And I said, on the one hand, absolutely, I believe we must be more agile. Darwin said it's not the strongest of the species that survive. It's the one that's most adaptable to change. And I think that's a pretty good thing to keep in mind. But at the same time, you can't constantly be pulling your punches or creating maximum optionality. If you look at some retail concepts that have been very, very successful, like say RH, or Nike House of Innovation, or some of the luxury players, great stores, that's not because they created the most flexible environment. It's because they made a statement and put a lot of capital into something really ultimately remarkable. So I think you've got to pick your spots very carefully, but certainly your operating model has got to be much more agile than has been the case in the future. Supply chain problems are probably the biggest example of that.
Yeah, what, there were supply chain issues? I didn't even hear about that.
Yeah, I heard something about it. I don't know.
Anything that became more front and center that wasn't in the past, I think it's supply chain. I mean,
Yeah.
So there are obviously things that we're struggling, and we get it wrong sometimes, but also sometimes we get it right. And we love to call out fitness wherever we can, because it's one of the few ones that we got right when everyone was really down on it. So I just love to remind people that sometimes we are right. But I mean, from your perspective, when you look at those who are struggling, and there are a lot, like restaurant chains are struggling, and it's not completely their fault by any stretch, though there are things that they've clearly not done as well. And there's lots of segments that are kind of feeling the pain. Who do you think which of these segments or retailers do you think is likeliest to surprise in the coming months?
Well, I think the key to understanding that, I know that I've got a great example, maybe luxury, but I don't know if that's a big surprise. And I say luxury both because, and probably more the physical side of luxury, both because for the most part, you've got a consumer that's not especially price sensitive and is not going to be tremendously affected by whether we have, there's a lot of debate about whether we're in a recession or not, but, kind of getting away from the semantics of it, I think we're looking at a more difficult 2023 than 2022. Having spent some time in the luxury business at Neiman Marcus, generally you find that the most profitable customers may have a little bit of a short-term shift to their behavior, but largely speaking, they can afford whatever they want, and price inflation and general macroeconomic factors, aren't going to affect their spending. And there's still something about going into a store and, when you're paying a lot of money, seeing the goods, putting an outfit together, meeting with a sales associate, and most luxury brands have pretty compelling omni-channel or harmonized retail presence anyway, so they can leverage that. It's not so much about necessarily where the transaction occurs. So probably luxury. I think fitness and even going back to live events, there's still this magic. We're social creatures. There's still some things that are pretty hard to really substitute for in a completely digital experience. So I don't know if that's surprising that those have come back or are likely to continue to come back, as much as it's just a realization of the nature of human beings as social creatures.
You touch on it also with like luxury and experience. I think we had Billy Taubman, the COO and president of Taubman, on the webinar. One of the things he was saying that I think was really interesting, and I had not taken seriously enough in the past, was experiential retail is about the experience. It's not like climbing wall, and it's not a basketball hoop, and it's not, I don't know, darts.
Yeah, right,
it could be putting out a fancy mat when you walk into the Rolex store to make you feel like you're getting something special and different. And I think that is something that any retailer, any retail format, whether you're the shopping center owner, the mall owner, whoever, can learn from that. It's about, what do I feel when I come into your space, and does it contribute to the brand you're attempting to build?
Yeah, I think one of the things that I've been talking about for a few years, and I didn't come up with this, is, and you could argue it's a little bit overly black and white, but it's the idea of trying to understand whether the consumer is in buying mode or shopping mode. I've heard that described as errands versus experience. If you're just trying to get something off your to-do list, if you don't have any kind of emotional attachment to it, physical shopping might add value, but it's often pretty easy to, buy those batteries or whatever it might be online and just have it show up at your home or office, right? Or you're just running into Walgreens because you got a headache and you need some aspirin, right? Like there's nothing quote unquote experiential about that. It's about kind of the shortest path to meeting a need. But when it comes to a want or something more complicated, and you're more emotionally attached to the outcome, and that occurs across the spectrum, of course, then physical retail is usually much better at that than digital. Not that digital can enhance it, but you're much more likely to turn to a physical store. And there's a lot of ways that can play out. It could be the climbing wall, right? It could be the Canada Goose freezer dressing room, that helps you understand the value of the product. But it also could be going with your friends to hit the restaurant up, next to the boutique that you're going to get something for an event. So there's a lot of factors to it, but I think it's very important from a strategy standpoint to think about whether the customer is in buying fundamentally or shopping mode, and that often will be a good predictor of what their behavior is going to be, and in some cases what you need to do to capture that shopping occasion.
That's so interesting you said you bring this up, because I was thinking of, and I've been thinking of CVS and Costco a lot recently because I'm very cool. And I was thinking about,
You got that kind of time.
but when you kind of, there are two places that I walk in with a set list of things I'm expecting to buy, and my cart is double what I expected.
Yeah.
And it's like, a Three Musketeers bar the size of a small child in CVS, or like the random, there's just, I once said to my wife, it's CVS, if they have everything you could ever need, and it's the one you're like, oh, we're missing this one thing. So they somehow have every one of those things in one store. And I'm like, even that is an experience, but it stems back to what you said earlier. Like, do you know who your customer is and why they walk through your doors? And at CVS, I'm walking in somewhat in desperation mode, whether it's to get the kind of a shampoo, deodorant, or a pharmaceutical product. Like it's an understanding of my state of mind that's really important, and I don't know that everyone has that.
No, I think I've been thinking a lot about this, partially because it's I'm working on a new book. I don't talk too much about that at the moment, but one of the things I think is really important, when you're in a world of abundant choice and abundant information, where the customer's got so many choices about product, can get it 24/7, in some cases can get it from pretty much anywhere in the world. Having everything is not necessarily a winning strategy. So I think if you're going to curate, to use the overall word, edit's probably a better word, your assortment, the more you understand the customer or customers and their purchase occasions and focus, the better off you generally are. I think Tractor Supply, if that's a company that people don't know, they should check it out, because Tractor Supply has been one of the most successful retailers over the last decade, and I've spent some time with them recently. And one of the things that Hal Lawton, their CEO, said to me was, one of the benefits of Tractor Supply is they haven't decided to build a bigger store, fundamentally. And that discipline around space, which you can certainly also think about on the website, but in a physical manifestation, being constrained by that space, but having to choose what gets added or taken out against a much more focused set of customers, is keeping them from the tendency to be a little bit of everything to everybody. And I think if you look at the retailers that have struggled, for the most part, even if they're more narrow in their business model, like a Bed Bath and Beyond, they've still struggled from being a little bit of everything to everybody, which allows other competitors to either pick off certain product segments and do it better, or other retailers that have many more locations or more convenient locations to steal some of that business. So yeah, aiming better is I think a pretty important part of what makes businesses successful. It's a little bit easier to manage that on the web. than a physical manifestation. But mostly we're talking about retailers that, are physically dominant.
That's an important point. Now we get to shift to the trends. Again, any questions, please throw into the Q&A. I want to start with one that, again, this is a shout out to our last guest, Andrew Lipsman, who was the guy who turned me on to this. In reality, we've been talking about this a little bit, but like he was the one who really kind of knocked it home for us coming off the back of Shop Talk. But these kind of retail media networks, these in-store, this recognition that the store is not just a place to sell, it's a place to promote. And, we've seen, a lot of buzz from this space. How big of a deal do you think this is for brick and mortar retail? And what is the key to taking full advantage for retailers?
Sure. Well, first of all, Andrew's work, I think, is terrific. We just recorded a podcast episode with him, and I'll be out in a few weeks. If you want to check out the podcast, you should definitely check out the episode that you were on recently, where we had Retail Fight Club. But anyway, enough of the shameless plug.
I was going to shave the shameless plug. If you want to hear someone passionately, the only person passionately defend Kohl's, definitely check out that episode.
Well, usually you're right, but in this case, you might be wrong. But anyway, I might have mopped the floor with you, but people will have to decide for themselves. But anyway, back on point. I think retail media networks are clearly one of the biggest, maybe you could argue biggest stories in retail today. It's a bit funny, I always feel like since I'm so old, I kind of feel I'm talking to the kids, in my day, but this idea of retail as media is hardly new. You can go back to the OGs of direct to consumer, the Williams Sonomas, the J. Crews of the world that recognize the marketing value. That was a big part of why they opened stores. And they found, just as Warby Parker has found, that when you open a store, it is advertising for your direct to consumer business. Now, back in the day, that was mail order catalog, right? Now it's e-commerce. So this idea that a physical store is advertising for your brand is not a new one. But I think what's going on now is, number one, we've seen from Amazon's massive profitability. Some people, and I think probably rightly so, are arguing that Amazon advertising is the most profitable part of Amazon, even more profitable or soon to be more profitable than Amazon Web Services. And you can make the argument that retail is the sort of the loss leader to sell advertising. So we've seen that with Amazon. We've seen that the cost of paying what I call the marketing toll booth operators, the Facebook and Googles of the world, has become astronomical. With some of the privacy changes, this ability to leverage first-party data in a different way is there. There's a lot of factors that are driving the interest in retail media networks. So I think there's just been a series of changes that will propel this forward. Clearly, a lot of retailers are waking up to this possible opportunity and how profitable it could be. So I absolutely expect this is going to continue to be a huge area of focus for quite some time. My concern would be, and I think this is where maybe I might be a little bit more muted in some of the more optimistic projections, is retailers still need to balance what consumers came to the store or came to the website to do, which is to buy stuff, not be pitched. And so, I'm generally pretty skeptical of how far you can push interruption-based marketing. Or you can push it, but you have to balance the primary thing the customers are there to do, not the secondary things to do. But that will be worked out over time. But absolutely, I think we're going to see huge growth here.
I also think it's going to open up it creatively. I think the combination of seeing people succeed with it, the Amazon effect, I think is absolutely enormous here. But also what it kind of unlocks because of these different concepts. Like one of my favorite things to look at is the M&M store in Orlando. And I always find it mind-blowing how many people walk through that store a year and spend, our data only sees a visit of 5 to 7 minutes or more. And so the number of people who are spending 6-7 minutes within a M&M store location, what that does, especially if it's a younger audience, it's about so much more than how many packages of peanut M&Ms you sell. It's about that's where it's like, oh, if I'm looking at popular grocery stores in certain areas, I mean, this is something we had seen kind of micro influencer companies working off online, but that same concept could apply here where I want to be in every Publix that, is over indexed for a specific audience with certain products to push those products, ability to bring that whole
Sure.
mix together.
Yeah, absolutely. Well, and I think, the other thing, which is certainly related, I mean, it's not like it's a new idea of leveraging customer data to drive your business, but the ability, the growing ability to get access to data, particularly the first party data, is huge. And you don't know yet, I think, in most cases, where that's going to lead. Because, really the big advertising network right now is Amazon, pretty much exclusively online. But to be able to leverage the physical experience and the ability to put the online and offline data together potentially, it's going to unlock a tremendous number of opportunities, whether it's from the standpoint of pure advertising revenue and ability to charge others for that, or to improve your business model, that level of insight. So I think we're going to see retail media networks be a profit enhancer for sure on its own, but I think it's also going to have some secondary effects in terms of really being able to hone your value proposition and be more relevant and more personalized, which maybe turns out to be the bigger thing, even if it doesn't show up exactly on your P&Ls directly.
Yeah, it's so interesting, by the way. This is the Amazon in retail question. And I think even for as much fear as they've kind of sowed of like, oh no, Amazon's coming, I think they've unlocked so many great ideas and so many innovations that have been adopted really effectively by a lot of players within kind of the brick and mortar space. I think overall their net contribution to how retail has evolved and innovated is really significant.
Yeah, I think it's a great learning from at least two perspectives. One, I'm been very interested in just from an innovation standpoint is, and it kind of goes back to, if people are familiar with the innovator's dilemma kind of idea from 20 or so years ago, which is, it's often the outsiders that really, wake us up to the opportunities. They're not burdened by legacy assets. Maybe they have a whole different way of making money, which is obviously the case with Amazon. And they just see things in a different way because they're not constrained with their old thinking or defending the status quo. So I think that's an important lesson for every retailer, is to take that kind of beginner's mind outside perspective. The other thing with Amazon, which I think can be a little bit dangerous for people to chase, is they just have a fundamentally different way of making money. I always say that it's almost like Amazon retail has become the razor to sell the razor blades. The razor blades being advertising. And so if you're a traditional retailer where you don't have the opportunity of the same scale anyway to do third-party marketplaces and fulfillment services, and even forget Amazon Web Services, because I think that's a little bit of a distraction. But just from a retail perspective, it's not so much about making money selling product; it's about making money from services, which is maybe a little bit more like a Costco membership fee kind of thing. So you got to be careful not to engage in a race to the bottom on the product side, or just sit around whining about how come Amazon doesn't make any money. Well, they do. They just make it in a different way. So, but the more, anyway, to stay on point with this, the more that retailers get into the retail media network, I think it will allow them to say, well, it's more of retail as a platform for making money, and there are various revenue streams. It's not all just about product and inventory turnover and the things that we traditionally measure.
Oh, it's such what, I know we're going off the rails a little bit here, but it's fun. So I mean, we can enjoy it. I think you bring up something so
You tell the
important.
audience to talk amongst themselves.
Yeah. I think there's something, and it's one of the things we hear a lot about is talk about kind of innovation in tech. And this was going to be the one of the slides that I don't think we'll have a chance to get to, but hear a lot about innovation and these really cool technologies that are flying carts and whatever, that a robot that makes your cereal for you. And it's in the end of the day, it's too kind of, how do we be innovative, not how do we solve a problem for the consumer. And I do think you touch on this, like Amazon has a keen sense of why it does certain things. So we talked about cashierless checkout. It's about cameras in the store so you can bring in data on the customer journey. It's not about getting rid of the not overly expensive person who's checking your items. And I think we need to refocus on technology is there to solve a problem or it is not valuable enough.
Yeah, I mean, I often say no customer buys technology. Customers don't care about technology. It might, it might provide the validation to us. If they're skeptical about how something has changed, that might be the thing that gets them to be convinced that this is new. But customers want solutions. They want to be able to tell a better story about themselves in a lot of cases. And so the more we're focused on the problem, I always say, people say fall in love with the problem. I think you want to fall in love with the solution, and have that orientation. And absolutely, technology can be hugely important to being able to do it at all, or to be able to do it in a cost-effective way. But yeah, there's a lot of kind of technology first. We need to be digital first, or whatever. That's a common thing to rally behind. And I think in many cases, it could take us down the wrong path, or have us fall in love with something that's not worth falling in love with.
I think we're also just looking in the wrong places to a large extent of like what's going to drive us forward. It's this exciting innovation when it's not. It's generally these iterations on how do I make life easier or better for the consumer that make all the difference. We're running short on time, so I want to get to two quick ones. And the first is, I want your overall expectations for the holiday season, and I want one bold prediction for the holiday season.
Bold prediction. Well, the bold, I don't know if this is so bold, but the bold prediction is I think transactions will be down year over year. I think that will be the first time in quite a while that will be true. And I think that's largely because of macroeconomic forces, including inflation. But I think one of the things, and maybe this is either too obvious a point or too sort of inside baseball, but it's been a long time since I've paid much attention to inflation. We've been in kind of a 2-3% mode for quite some time, and now we're more in the 9 or 10% mode, which can have the effect of retail performance. So if retail sales were up, say 5%, you'd go, that's pretty good, better than average. Well, now this year we'll have plenty of retailers that will be up 5, 6, 7, 8%, but they will be down on transactions. And it's ultimately, I think, that customer frequency and engagement that is the best measure. It's just going to be hard to read it as well because of inflation. So I think from a aggregate sales level, it'll look like a pretty good year. I think in reality, it's going to be pretty lackluster on average. And it will come earlier, and it will come, I think, less profitably for at least the apparel sector because of the just huge amount of inventory they need to move through. So I think margins will be down.
Don't you think? And I think the margin question is a big one this year. And I guess the question I have is those who can, is this actually a long-term potential benefit? This idea last year that like prices were up and the consumer paid more, and isn't that great? Yes, in that perfect environment continuing. But the second there was an economic challenge, we saw that disappear. Like now you have too much inventory, the customer doesn't have as much to spend. There is this idea that I look at kind of the Targets or the Walmarts that got hit so hard because their margins were getting squeezed, even though their overall sales were up. I think there's something about, hey, we still have prices, we can be there for you even in this difficult period. It's a really powerful message from a long-term perspective. It's a very rambling way to ask, I mean, how much benefit do you give to the retailers who are able to, even if the margins aren't there the way they were in the past, who are able to kind of drive those sales increases or transaction increases or keep that customer loyal even in this difficult period?
Well, I think if you're known fundamentally for low prices like Walmart, or exceptional value like Target and other some others, then it is, and you're in a world where consumers, your target consumer is very worried that they got to stretch their dollars, then it may be a bit painful it will be a bit painful in the short term from a margin perspective, but that accrues or certainly doesn't damage your brand equity. So I think for some retailers, it's a short-term issue that they can easily withstand, and it doesn't do anything to deteriorate the brand. If you're Kohl's or some others, and there's a sea of inventory, like you can go into most Kohl's stores and it is just packed with product at ridiculous prices. I think some consumers may go, "This is great," But part of the problem is, how many sweaters and coats and pairs of jeans, can the market absorb? So I think that, that where you really have a true glut and you look desperate, and you already are a bit challenged to have price integrity. It's not helpful. I don't know that it will be tremendously damaging, but it does not really reinforce your brand position. And from a merchandising standpoint, it's a mess on the floor. So that's going to be a bigger problem, I think, for some of the apparel players, not so much the more hard discount players.
I think your Texas anti-sweater bias is coming out, living in the heat. With that,
I did spend most of my life in the north, though. So,
that's fair. You have an appreciation or a disdain for the winter. Either way, Steve, thank you so much for being here. This was a pleasure as always. Always kind of a joy to have these conversations and to hear your expertise. Again, everyone, please, Remarkable Retail is absolutely a fantastic read, and it is a must. So please check that out. His podcast, also called Remarkable Retail, is also fantastic, and there's a great episode on Kohl's that you really need to take in. And Steve, thank you so much for being here.
Thanks. This is fun.
Thank you, everyone, for joining us today. Join us in just 2 weeks when we're going to be having our next webinar, and we're going to be focused on our holiday expectations with the friend we mentioned earlier today, Simeon Siegel. So please make sure to join us. Have a wonderful day. And thank you so much for being here.